Good morning. I'm Bobby Yazdani from Cota Capital. I'm based in San Francisco. Thank you very much for joining this morning. I'm just going to wait for a few more minutes to see if we have other participants who are coming in. I have a presentation that I'm going to share with you, a bunch of fun facts that I put together and kind of outlining what we see here in the Valley and, what's the progress. It's been a lot of turmoil, as you all have experienced since the beginning of the year. But all in all, we try to rationalize what we see on the ground here in Silicon Valley and share those views with all of you. So I'm going to get that started. Here we go. All right. Let's get started. Just 30 seconds on Cota. We are based in San Francisco. We have over $1 billion asset under management. Our focus is in enterprise technology, early stage companies in enterprise technology. And we are kind of what we refer internally as our focus has always been on net new areas of technology. We are kind of frontier investor. Let's start from the top, kind of what we are seeing and what's going on. And this is a pretty good chart showing the kind of correlation between the 10-year Treasury rate and S&P 500. So S&P 500, as of days ago, it was off 12% from all-time high. But when you look at over the past 5 years, the performance of the index is up like by 85%. That's just trying to provide a bit of a context that this turmoil since we've seen in the beginning of the year, it sort of feels like a correction more than anything else. And that correction would have been coming in independent of some of the policy announcement that the administration have announced since the beginning of the year. So we kind of ended the 24 at an all-time high, and here we are experiencing a correction. So in a nutshell, I mean, this correction were expected, and many people expected that, independent of the policy announcements that we have experienced. Still, the top three magnificent three names, Microsoft, Apple, and NVIDIA, a valuation of those three companies, even as a few days ago, is, and post DeepSeek kind of announcement, is still significantly higher than it's equal essentially to the entire China market. So it's still, and we are in full swing in terms of the value of these companies and what they bring to the world and their kind of competitive positioning on a landscape basis. So we are seeing a correction, and you can also see in this chart, China market has somewhat recovered since the beginning of middle of last year, and sort of like you'll see that similarly the AI shift and emphasize how you'll see it in the China Stock Exchange. So that momentum is not only in the US exchanges, but also it's in China exchanges. The enterprise value has also retreated since the beginning of the year. You can see in this chart all the top names or high-flying names like Palantir or Cloudflare or CrowdStrike. They have retreated by roughly about 20%. So 15 to 20% has been the retreat, but again, it's correlated to the S&P 500, correction that we are going through. So there've been a drawdown of the market, both in terms of valuation. They've been drawdown in terms of the overall indexes. But again, if you look at over the past 3 to 5 years, I mean, these indexes were all-time high, ending the 2024 calendar year. The looking at the S&P 500, the top 10 stocks still continue to be the tech companies in the index, even though those top 10 companies have retreated significantly, but still, that retreat is fairly significant. And the top 10 companies continue to be primarily dominated by technology companies. So they are still a big portion of the S&P 500, even though those very names have retreated significantly since the beginning of the year. So this drawdown, there's a question for us is it really a correction because of the fact that we ended the 2024 at all-time high, or is it correlated to something else fundamentally that's going on? And primarily to do with the policy announcements and the trade announcement that the current administration have gone effective with since the beginning of the year. I mean, I get tons of questions around what are you guys seeing on the ground? What's the implication of the trade essentially policies that was announced? One of the interesting data that we collect is the relative, distribution of value, names in the index versus the growth names. And you can see from time to time, depending on the momentums, this thing varies. And now you'll see that the value and the growth in terms of the dispersion has closed. And you can see that it's evenly distributed between the value and the growth stock in the S&P 500. The M&A activity in our core sector still is subdued, is essentially flat year over year. We were hoping that we're coming to this year full swing in terms of both the IPO market and the momentum around the M&A activity, but it's remained quite subdued. So the implication of the drawdown, it's everywhere in terms of the willingness by the people to go through an M&A activity, willingness for the markets to take on new IPO shares. All of those things have come to a bit of a halt for these set of policies to settle, and we have clarity around what those policies means in terms of the trade, in terms of the implication in the economy, in terms of the growth of the economy. So we are in this very period that everybody is sitting on the sidelines and watching around the implications. So we try to in one hand, we've seen the drawdown. There's a question, but there is a drawdown. It's just a simple correction related to the valuation, and it ran up pretty fast and pretty furious throughout the 23 and to 2024. Or is it something more fundamental? And that's to do with, is there going to be a significant slowdown? What's the implication of that slowdown to our companies that we are invested in, or the markets? And we're trying to, again, rationalize all of those things. Now, going back to some more fundamentals, we were looking at the energy, and again, the fundamentals have not changed. When we look at and ask ourselves whether the energy demand is going to be there, and you can see the energy demand is on the rise. And you can see also here in this chart the sources of the energy, and where you're seeing the renewables are taking a bit of a setback, but I think it's going to come back sharply over the years to come. Natural gas, of course, has replaced coal, but no question that the energy, broadly speaking, and the demand on the energy is on the rise. So that is also a question. Is maybe there would be a slowdown a little bit short term, but again, long term, the fundamentals of the energy and the energy consumption is on the rise. Of course, the fundamentals of the demand on the energy from the growth of the technology and the technology infrastructure is in full swing. There are a couple of charts here that shows the expected energy consumption by the data centers for the next 5 years is quite significant. You can track essentially the number of the data centers being built in the United States in particular, and also on a global basis. And also you can also track the number of EV charging stations that are going online in the United States and globally. It's on the rise. So both of those uh, segments essentially of demand, being the data centers and electric vehicles, are is in a multi-year expansion, and hence the need and the demand on alternative energy, broadly speaking, and energy as a whole is in a full swing. Um, One other data point we just found out is that this is an interesting chart that shows that if you look at the birth rate in United States is significantly down, and these have massive implication to the economy. The question is, looking at the immigration policy, looking at the, kind of like the way our economy is now being organized and the possibilities of expansion. I'm talking about organic expansion, through birth is also a question. What's the long-term implication of the significant the lowering of the birth rate in the United States? And you can see this chart, how fast he's dropped since 1960s. So those are the big kind of macro interesting data sets that we wanted to share with you. And now I want to go and focus on what is happening with the kind of the US-China trade war. I mean, this is really focused on the US-China. I mean, everything else I think is on the kind of like necessarily not the core focus of the administration, but it's broader in terms of the announcement, but the core focus is on China. One other thing I want to touch on before I get into the specific of the China trade is the fact that we have a significant annual burn rate in our federal government, and this chart shows you that there's a $2 trillion essentially burn rate. As an investor, we look at what's the deficit and where does that come from, and you can see there's a close to $1.9 billion deficit that needs to be addressed by the government. So the U.S. China trade, the deficits that we are facing, the slowdown that we expect, all of these pieces are kind of coming to a head very early in the new administration. So they're trying to go after the deficit on one hand. I mean, we are not, these are all above my pay grade to really comment on their approach or how they are going to address this significant deficit, either through revenue or through cutting cost, and how they're going to be approaching it. But if you're looking at a business, you look at the revenue CAGR is subdued from 2015, meaning that the revenue growth of the of U.S. government has been around 1.5% since 2015, while the burn rate of this growth business is significant and it's not sustainable. So addressing the deficit is an important challenge for the country, and we collectively are going to have to go after it and figure out how do we address this deficit. So what we are seeing again from outside is that the administration is trying to cut costs in one end. And you heard about the DOGE, the effort of Elon Musk and people in the administration. And on the other hand, increase the revenue partly through essentially the new trade policies that they're putting in place, hence trying to address the national debt going forward. So nothing is really settled. I would be talking further as we are looking under the hood and understanding where is the revenue going to come from. Is it really the trade, essentially new policies are going to contribute to the revenue, or on or is it really going to slow down the economy that's going to impact the broader revenue that the federal government is collecting? I have no idea. We'll see the implication of it once they announce the Q1 and the Q2 GDP growth, and we'll see what the implication of that is going to be. And also, we're going to see what at least truly, what's the cost reduction that they've been able to achieve since the beginning of the effort by the administration to reduce costs. Going back to the global trade for a minute. I mean, this is a important chart to show you that the global percentage ownership of the trade, and you can see that for as far as United States is concerned, they were just below 40% back in 1990, and today it's only 11% of the global trade is contributed by the United States. What's been rising, on the other hand, is of course the Asian nations in particular. If you look at China, Taiwan, South Korea, they are in full swing in terms of the expansion of their trade. US, Europe, and Japan is retreating. They've come down significantly. I mean, you look at the Japan charge. I mean, they were contributing over 40% of the broad global trade back in 1990, and here they are. They only have 18%. 15% market share. And you look at Europe similarly. I mean, they're kind of flattish, but still is significantly down. And the US and I would say Japan are the two nations where they have lost market share, significant market share. So if you look at US as an entity, you look at the revenue, you look at market share, you look at the burn rate, it's just not sustainable. And are we fundamentally addressing it? Is independent of who's running the government. These are fundamental data that demonstrates that we are losing market share on a global basis, and we are running a significant deficit running our country, and it's not sustainable. It's not sustainable and needs to be addressed. Another area of interest is to look at sourcing, strategic sourcing. I mean, it got highlighted during the COVID. The dependencies really surfaced. As an investor, we had a number of companies that they suffered in 2020 and 2021 because lack of availability of the parts. And we did not have access to the parts. And in 2022 and 2023, the prices were very high. It was very hard for us to get a hold of all the necessary parts that we needed. And it's demonstrated the dependencies that US businesses and the US economy has to strategic parts and strategic sourcing. So this chart shows you that China dominates the rare earth material, and those materials are an important and significant part of the US tech industry. So the US tech industry is highly dependent in the current sourcing of these materials that comes from China. And therefore, there is a renewed effort to looking at where are the other places we can source these rare materials, number one. And secondly, is that whether there could be innovation that's going to essentially challenge those rare materials with new materials that's going to arrive. We have to see it's not an overnight effort. And this strategic sourcing is national security as far as the US is concerned, and the dependency that our US tech industry has on this material, and hence getting to essentially to a place where we have friendly trades with all of our partners, including China, is an important aspect of our industry. So these dependencies are started to surface, and it got emphasized, as I said, significantly post-COVID, and the level of dependencies that we have both in terms of the rare earth materials and minerals it depends on, as well as the parts that's being manufactured and exported. Going back to the previous chart, the dependencies we have in South Korea, the dependencies we have in Taiwan, the dependencies we have on China to get access to parts that is required by our industry, and those things are is certainly at the focus of the current administration and many of our businesses. Looking at the exposure, so we talked about dependencies on supply chains, material, and now let's touch on revenue. This shows you the dependencies and which sector is highly dependent in terms of the exposure to the China, to Europe, to Canada and Mexico and the rest of the world. And of course, the tech sector revenue is highly has exposure to the international markets. So you can see from this chart that 25%, the largest percent. I mean, you can see China, Europe, Canada, and Mexico in this chart. The tech industry is highly dependent on that revenue, where you can see the China exposure is around 15%, but Canada and Mexico is, of course, significantly higher, and the list goes on. So this is the potential revenue impact that these trade policies could have in the tech sector in particular, where, again, tech sector is highly dependent on international exposure, international revenue, and the dependencies on these particular segments that you'll see on this chart. Going even further, as I mentioned, you can see that is another way of looking at the same thing, is that the China exposure is at most 15%. And it seems that is the primary focus of the administration. And Canada and Mexico is relatively small, and the Europe and the rest of the world is quite high. So I would say 15%. I'm not convinced that the exposure here is on the revenue side. I think the exposure is mostly on the supply side. So it's more on that front that I'm concerned about. I'm less concerned about necessarily the revenue exposure with respect to our sector and the trade policy and the trade war that we are seeing today. So with all that going on in the background, the drawdown on one hand, the trade policies that was announced over the past 30 days, the turmoil that has had in the market, and the unknowns. What's the revenue exposure? What's the cost exposure? What's the implication to the forecast, both on the top line and the bottom line? Is it going to have an implication in the overall economy and the slowdown of the economy? Having said all of that and all of that background noise and all those background activity, the AI is in full swing. I mean, every day here in the Valley, the progress, the rate of innovation, the nonlinear curve of learning, the many thousands of brilliant people, working to take AI to the next level, and this nonlinear learning that's going on, it's in full swing. Nothing is slowed down. Nothing is slowing down here, both in terms of the talents and the brilliance of the entrepreneurs going after it, and the capital that's looking for a once-in-a-lifetime opportunity to get exposure to this beginning of a new super cycle that's in front of us. And there is very, very broad of all the innovation that's going on. Again, we listened carefully to all of the the hyperscalers, listen carefully to the big businesses that are laying out the core infrastructure of the AI, Microsoft, Google, of course, AWS and Meta, and the level of investments of all these simply four companies, and then broadly speaking, Oracle and SoftBank and many others, is in full swing. I mean, there is significant amount of money being allocated to position these companies for this new super cycle, and that built out is in full swing. And hence, what we touched on earlier on is the new data centers that are being developed that are AI enabled or AI infrastructure data centers, and the amount of energy these data centers are going to be consuming, and many NVIDIA chips and many other chipsets that they need to enable this new set of data center. I mean, I was just listening to the news earlier today, and they were talking about would there have an implication in NVIDIA chipset? No, there is more demands. There's just not enough NVIDIA chips, whether they get exposure to the China market or not. That is one market, but is the other markets are going to be able to pick up essentially the availability of that supply? And the answer is yes. When you listen to the work that Elon Musk is doing with combining XAI and the old Twitter X, and what they're trying to do and the level of investments they're going to be making in, they're going to show up on this chart. They don't quite show up on this chart yet. They are coming. And XAI, which is the core infrastructure, data center infrastructure for both Tesla and SpaceX and X and the other entities that Elon Musk have created, is going to show up here. And they're going to pick up as many chipsets as available, and there would no slack in the supply. And they would be able to. Same thing with SoftBank. SoftBank similarly is going to go in full swing developing this, the Stargate infrastructure. They just made a significant investment on OpenAI and partnering with them. And you will see the similar data centers are going to be built in Japan. Similar data centers are going to be built in Korea, and the list goes on. So we do not see that this kind of fear of slowdown, the fear of the slowdown, it's going to essentially manifest and become reality. We think all of those would be essentially, it's in full swing with the AI as a growth engine, a core element of the growth engine in the market. These are good example. I mean, even since the last time I was on this call, I mean, Apple made a massive, announcement around a $500 billion investment in the United States. Similarly, NVIDIA. So while you're seeing the concern around the implication of the trade policies and the implication of it to the overall economy, and then on the other hand, you're seeing a significant amount of capital being deployed in the United States, by major players like NVIDIA, Apple, Oracle, SoftBank, and OpenAI and Microsoft and many others. So this is in one hand, you feel like, oh, is this all these trade policies going to significantly slow down the U.S. economy? But on the other hand, you're seeing that all of that could easily be replaced by the internal demand, where this level of investment, which is between these three efforts, is $1.5 trillion of investment over the next 5 to 7 years. I mean, these are massive infrastructure projects. And I'm not talking about the CHIP Act that started during Biden administration and is going to continue. I mean, TSMC and many other initiatives in the United States building fabs to bring back essentially the semiconductor industry and the manufacturing of the semiconductor industry in the United States. Those are real demands. The demand on the energy is an internal demand. That's going to be in a full swing in terms of the alternative energy and new power sources that the economy needs. You're seeing, not only, as I said, the manufacturing is coming back to US, the demand on the energy is going to be in full swing, the level of investment of the high-tech companies in the United States. And then the AI boom is going to have broad, both productivity implication, lowering the cost of businesses, and new demand for the technology. So I believe that a lot of those things are going to be replaced if it's a slowdown on the trade side, but then there is this core organic, very large, very massive set of investments that very likely is going to replace the sort of like the dependencies on the trade. So the AI is in full swing. We are tracking the adoption of AI. I mean, there is not a single day that we sit in this office and meet brilliant entrepreneurs who are taking all of these intellectual properties from the AI and applying it into the core enterprise to improve the productivity, to improve the forecasting, to improve the capabilities of the enterprise to be able to increase their top line, decrease their bottom line, improve their productivity, manage their risk. So the AI is in full swing, overlaying on all the core business processes within the enterprise. Hence, the adoption is in full swing. The demand for AI capabilities is in full swing. The awareness that the level of productivity gain is incredibly significant, and the nonlinear improvement of the AI and the adoption of the AI are both on nonlinear curves, and they are in full swing. The other thing that is as I want to focus on is on the innovation side of AI. The cost of AI is going down. The cost of developing software is going down. The availability and broadening the availability and accessibility of the AI is significant. I mean, you're seeing now, from a very simple set of productivity tools that knowledge workers use to very sophisticated business processes around supply chain optimization, forecasting, inventory management, risk management. We are seeing all of these business processes. All of these business processes are adopting AI in a full swing, and we are seeing the significant productivity gain that this technology has for our businesses and our economy here. This is a very good chart to show you that in a matter of literally less than 2 years, you can see the cost, which we in here is talking about the cost of AI tokens is gone down by more than 2 orders of magnitude. It's significant. This cost saving is significant, and the broadening of the availability of AI is significant. This is not just ChatGPT. This is about machine learning. This is about all of the innovation in the LLM that we are seeing across not just the OpenAI or Anthropic, is across all of these players is quite significant. What are we focusing on? There are places that we believe that is a good category for us as an investment firm to go after, and there are places that we think it's not necessarily the best use of our capital and the risk reward around our capital. This is a pretty good chart. I mean, this is it's oversimplification in some ways, oversimplification of what we call the AI-centric technology stack. So we do not touch the core data center. This is not an area that we invest, but we observe and watch, and we partner. including with Amazon and Microsoft and other hyperscalers. Then there are cloud platforms that sits on top of these data centers, AWS and Azure and Oracle and a number of other ones that are there. Again, that's an area that we do not invest, but we keep track and look at the nonlinear innovation that's going in each of those layers and the AI enablement that's going on within each of those platforms. And then you got the models and the applications. The area that we are greatly focused on is in the middle section, which is the AI tooling, AI application, and AI models. But the AI models, we are very selective in terms of whether there are specific vertical models for very specific vertical use cases where our capital could have a meaningful impact, helping innovators to make a difference. But when it comes to AI tooling and AI application, we are in full swing. So we are seeing a lot of great companies that are essentially doing frontiering work with those sections and those areas. We are seeing on the AI applications number of companies who are looking at the core horizontal processes, or they're applying in specific vertical areas. We have investments in both of those areas, and the AI tooling is the enablement capabilities where people who are building applications or models can leverage these toolings and the tool sets to be able to do their work. So this is how we view it. There are places where we and our capital is not the right capital for investment, and we think that the risk and reward is not appropriate for our capital and our area of expertise, and whether we can move the needle for our companies. But in the middle section is where our focus is, and that's where our team are sourcing opportunities, that our team is constantly researching and trying to understand the landscape of these areas and articulate and connect the dots. And we're kind of like the investigative journalists, or we are constantly searching to connecting the dots and understanding whether there are core trends are manifesting in each of these areas. And of course, learning every day. And part of our work is to write and share those writing both with our entrepreneurs and our investors. We think, of course, software is going to be massive category. I mean, I've been around software since I started in Silicon Valley back in 1987. In 1987, when I graduated from Berkeley, I came in and it was the beginning of the software standalone businesses. Oracle, it was the beginning of the Oracle and the Microsoft and many other ones. And since then, there's been no stopping. And the growth of the software has been significant. Software is going to continue to grow significantly, and AI is only going to accelerate it. And there are going to be more and more AI-enabled software replacing the old technologies, and the software constantly is going to get upgraded, and new techniques, new methodologies, new algorithms are going to replace the old. And we think the largest piece of the AI infrastructure and the AI applications are going to be, a big portion of it is going to be software. And that's where our focus is, and that's where we are going to be, investing our time and money, essentially going after this. It's in the beginning of a cycle, a massive cycle over the next 10 to 15 years. We'll see what comes after AI. But boy, this one is larger than what I have seen, from the beginning of time when Oracles and the Microsoft and the Ciscos started, and till now, where we have seen multiple super cycles from internet to mobile computing to cloud computing. And here we are, yet another super cycle within the software sector. So very pleased to be alive and be part of it, and very pleased that being able to really interact and watch this brilliant talent thinking about how they're going to leverage these new techniques and methodologies and technologies to change the world. And it's in full swing. Um, I'm gonna conclude today's remark. It was short and sweet. I hope it was helpful. My team is, recording this. We're gonna post it on our website. For the people who registered, I'm gonna share a copy of this presentation also with you. With that, thank you again for listening in. Thank you for joining my call this morning again. Wishing you best for the rest of the week. Thank you.